Welcome to the Women in Wealth podcast, brought to you by Regina McCann HESS, a certified financial planner with over 2 decades of experience. This show is for professional women who want guidance in working towards their retirement vision in learning, building, planning, striving for your dreams, and putting the work in now so that you can pursue your financial independence.
Hello, I'm Regina McCann HESS, president of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about 10 things that you should know about capital gains. And capital gains are something that we're probably all thinking about right now because we're getting all of our tax paperwork together. It's that time of year. So when you sell stocks, bonds, or fund shares at a profit, that could have implications for your wallet beyond just simply increasing its contents. So the first thing that you should know about capital gains is that there are capital gains and capital gain distributions, two different things. So a capital gain is when you have something that you are selling at a profit. So you paid $1,000 for it and you're selling it at $1,500. That $500 is your capital gain. Now, if you've held it for longer than a year, that is a long-term capital gain and treated at a more preferred tax treatment. If you are selling it under a year time frame, that is what we call a short-term capital gain, and that is taxed at whatever tax bracket you're in. So usually we really recommend people like, hey, it's good that you have a gain, but wait till that year time frame so that you can get that favorable tax treatment. And so that's what we like to talk to people about, is just kind of trying decreasing that tax bill if you possibly can. So now there's also things that you can't control. Obviously, you can control if you sell a holding, right? So you can control the capital gains when they're going to hit it by just delaying the sale of it. However, you may also have holdings like mutual funds or ETFs that actually have capital gain distributions. Now, can you control those? No, because the fund managers are the ones buying and selling inside that portfolio. And they're legally obligated to pass out those profits to you, the investor or the shareholder, because you're a shareholder in their investment. They're legally required to pass out those profits to you as capital gain distributions. Now, a lot of times that actually happens in the fourth quarter. Most of the times it happens in December. Sometimes it's October, November, but a majority of them hit in December. So if you're someone looking at your statements and you're like, oh, dividends were like, okay. And then all of a sudden you get this big kerplunk in December. That's not your normal dividends. That's your capital gain distributions. Now, again, remember, we can't control those capital gain distributions. They're forced out. However, you do have to document them and record them for Uncle Sam's purposes in your tax return. So if those capital gains that are passed out, they will let you know, the fund manager will let you know, they'll send a little recording about it. And anything that is held longer than a year is your long-term capital gain at that lower tax bracket or preferred tax caring of it. And anything that was sold prior to that year is a short-term capital gain. So again, you can't really control that, but what you could do is anticipate when they're happening, possibly sell the actual holding. But again, that gets you into another situation. Is that a gain or a loss? And if that's a short-term gain, either way, you're kind of like put into that situation. So just so you're aware of it, your tax reports will let you know if they're long-term or short-term as well, whether or not they're, a distribution from a fund. All right. Tip number 2 is that capital gain distributions aren't a response to action on your part. I kind of explained this, but we're going to say it again. You can receive a capital gain distribution from a fund that you own, even if you haven't held any shares or haven't sold any shares. The funds are required to distribute nearly all the capital gains that they accrue throughout the year. So they're not just accruing or realizing those capital gains in December. They're selling things all year long, and then they're just pushing them out to you at one full swoop, like just one time at the end of the year, and they're accumulating them throughout the year for themselves, but they push them out usually at the end of the year. Okay, so tip number three, you could see distributions even if your holding is in the red. What does that mean? So the actual holding, mutual fund, ETF, whatever it is, you could be at a loss on it. In other words, you paid $1,000 for the holding, and it's worth $800 right now. So you actually have a loss on it, but you haven't realized that loss because you haven't sold it. But they could have holdings within the fund that that they sold for profit. So you could still receive a capital gain distribution from that fund, even if it is posting negative returns for that year as a whole. So now this usually happens when a fund manager sells underlying shares for the profit, even though the fund itself has experienced a loss. Now they may have had, some short-term decisions that have made the fund in the red for that period of time, or just it's out of favor, a number of reasons why they're in the red, but they could have held holdings in that fund that they sold that they've had for a long time. And it's, they're taking their profit on them. So that's why it could still happen. Nothing gets people riled up when they see on the statement the holding is losing money and then they're getting taxed on a dividend. Those are fun conversation, everybody. Yeah, we love having those conversations. It's not, you don't control it though. The fund managers control that. And they have to push it out. So it's not really their decision. Okay. Tip number four is the tax man will not take those, taxes if it's in a retirement account. So what we've been talking about so far is anything that happens in a non-retirement account, you have to worry about the taxes. But inside a retirement account, like a 401k, a 403b, an IRA, those types of accounts, Roth accounts, capital gain distributions aren't taxable. They still happen. They still have the same fundamental thing where they're pushing out those capital gain distributions because they are required to. But the difference here is you don't have to report it to Uncle Sam on your tax return because that is staying within the retirement plan itself, whether or not it's the 401k, 403b, or the IRA, Roth IRA, whatever it is. It's still contained within the actual account. So again, like you can buy and sell things all day long in your IRA retirement accounts, and you're not worried about the taxes in there. That's the same thing for a capital gain distribution. Those are kind of like just like, okay, here's a gift. We got it. We don't have to pay taxes on it yet. All right, yet. That's a totally different conversation. Okay, when you have to pay taxes on that money. Okay, tip number five, a gift that could keep on giving. In a tax deferred account, if you reinvest your capital gains and those distributions to purchase more shares, like you have it on dividend reinvestment, it's not a taxable event. Again, these are your retirement accounts. They pay you the dividend, you reinvest the dividend. It's not a taxable event. You want to be careful with that information because it only applies to tax deferred accounts. If it's a non-retirement account, a lot of people ask me this question. This is actually a very common misperception. They're like, well, I reinvested the dividend, so it shouldn't be taxable. It is taxable. When you're in a non-retirement account, if you have that capital gain distribution, it doesn't matter if you cash it out, spend it, or reinvest those shares. It's a taxable event. It is reported on the tax form as a taxable event. So, you do the right thing. You do the right thing. Whether or not, if you need the cash, you take the cash. If not, you roll it back in, do some dividend reinvestment so that later on down the line, when you do need the money, you'll have more shares. So that's our thought pattern on that. Okay, tip number six is for the non-retirement accounts, how much you owe Uncle Sam will really depend on the length of ownership. I kind of alluded to this a little bit. If the asset is sold within a year or less of its purchase, it's considered a short-term capital gain, and it's taxed at whatever your tax rate is as ordinary income. So if I'm in the 24% tax bracket and I sell something at a gain, that's short term. I've owned it for 9 months. I'm going to pay 24% taxes on whatever that gain is. Now, same situation if the investments are sold more than a year after you've purchased them, they're considered the long-term capital gains, and they are generally taxed at a lower rate than your ordinary income. And we'll kind of get into that at the end here. All right, tip number 7. Dividends are different than capital gains. Now, dividends are a share of earnings paid to you as the current shareholder. And they are typically at regular intervals. They could be, it just depends on how it's set up. If you own a stock, it's usually like a quarterly dividend, thing like that. So if you do own individual stocks, the companies that you own shares may pay dividends directly to you. If it's in an account at like LPL, in your LPL account, those dividends are going to fall into the account, and how you have it set up is going to be determine how those dividends hang out after the fact, whether or not they're reinvested, whether or not they go to money market, whether or not at the end of the month, all those dividends that hit your account that month actually go to your, checking account or whatever. It's just how you have it set up. Now, if you own a fund, it could distribute dividends to you as well. Same thing, mutual fund, ETF, whatever. Same thing. It just depends on how it's owned. If it's owned an account at LPL, if you have a direct share somewhere else, a lot of times they'll also have you set up whether or not you want dividends paid directly to you or just reinvested in buying more shares. Again, we always recommend, hey, if you don't need the money, let it reinvest those dividends, buy you more shares so that by the time you do need money, you'll have more shares to sell. Conversely, also capital gains are only created when the asset is sold either by you or the fund manager. So capital gain distributions are different because that's holdings sold within the fund. A capital gain itself is when you actually sell the asset. Like you have this holding and you sell it, now you're going to get a capital gain. And again, we want to, if it's in a taxable account, we really want to hold it longer than a year so that you get that preferred tax treatment. Okay, tip number 8, look for your IRS forms 1099. If you still own your investments, you're going to likely receive form 1099-DIV. List all your dividends and your capital gain distributions for the previous year. And if you sold an investment, you'll also get something called a form 1099-B, like boy, which will show your capital gains or capital losses if you sold the investment for less than what you paid for it. So those forms go out February, sometimes March. Sometimes they'll reprint them because they're updating the information. Those are always fun conversations when that happens. But it can happen. You could have, gotten really excited. You got your 1099s early. You're like, woohoo, I got everything. I'm going to the account. We're getting everything done. And then, like a month later, there's a correction and you have to go back to the account and get it fixed. So that's something to know. It's something that occasionally does happen. It's not out of the realm of possibilities. Okay, tip number 9. If you win some but lose more, it could change the situation. So in taxable accounts, again, we're just, talking about what you could get taxed on. So in taxable accounts, if your losses, what we call the capital losses, are greater than your capital gains, then you net them out on the form 1099-B. And it could actually negate your tax liability. So let's just say you had $4,000 of gain, but $5,000 of loss, you're going to have a net loss of $1,000, which you can deduct on your tax return. And you can deduct up to $3,000 on your tax return each year. Obviously, you have to have the losses that exceed your gains in order to do that. If you had, say you had net losses of $5,000, then you would use $3,000 towards your tax return for this year. And then $2,000 you would get a carry forward for next year. So next year, your accountant will put that on your tax return as $2,000 loss, towards your $3,000 amount limit. So that's something that you want to pay close attention to. If you're curious about, do I have any carry forwards? Look at last year's tax return. It usually does say that on there, or secondarily call your accountant because your accountant probably has really good records of that and will be able to tell you. Okay. Tip number 10 is that some funds distribute more than others. Exchange traded funds, which have become very mainstream, and we call them ETFs for short, they tend to have relatively lower turnover. They may buy and sell internal securities less frequently. So they may also have lower capital gain distributions than other investments. Now, for many years, these exchange traded funds were passive investments. So that was very true for most of them. There are some ETFs or exchange traded funds that are becoming more actively managed. So you could have a little bit of a changeover happening where they may have a little bit more capital gains than they used to. So that's just something to pay attention to. But other than that, they generally do have less turnover than your, regular mutual funds and stuff like that. Okay, so those are the top 10 tips. Let's talk about the capital gain, the long-term capital gain tax rates. I won't go through all the different regular tax rates because that list is long. But for anyone for the capital gain tax bracket, remember I told you pay a lower tax on capital gains than you do on your normal tax bill. So if you're filing single and you make under 48,350, you could potentially pay zero taxes on your capital gains. If you're married filing joint, that number you have to make under 96,700 to have that 0% capital gain tax. And as head of household, you have to make under $64,750. Those are 2025 numbers. Okay, and we are sticking with the 2025 numbers because even though it's 2026, you're filing your taxes based on 2025 income and tax numbers. So we're going to stick with the 2025 tax numbers. So now that's zero tax rate for single filers under 48,350, married filing joint under 96,700, and head of household making under 64,750. Now we're going to go to the next step, and the next step is 15% tax on your capital gains. So for anyone who is a single filer making between that 48,350 and under 533,400, they get to pay 15% tax on their capital gain. That's a nice big wide range. Okay. Now, married filing joint, again, between that 96,700 and $600,050. So again, a nice range on that. Had a household over 64,750 and under 566,700. So nice ranges. Those are the ranges for the 15% capital gain tax. If you are making more as a single filer than $533,400, you are going to pay a capital gain tax of 20%. You're married filing jointly, any earnings over $600,050, you're at 20% capital gain tax, and head of household earnings above 566,700, you are in that 20% tax bracket. Now, obviously, there could be some other tax implications there too, but we're just doing kind of the basic type of things right now. So paying attention to that. And working with your accountant, working with your financial advisor can help probably help you understand a little bit more about your capital gains and how those capital gains and losses and distributions impact your tax return. Okay, so with that, I think our call to action is take a look at those tax forms coming in, those 1099 DIVs, the 1099Bs. Those are going to, tell you a little bit of information and help you understand what's happening and, what you're going to pay taxes on. All right. With that, thank you so much for joining me. Again, I'm Regina McCann HESS, president of Forge Wealth Management. My website is forgewealth.com. You can follow me on Facebook, Instagram, and YouTube at Forge Wealth, and on LinkedIn, Regina McCann HESS. You'll make it a great day.
Thank you for joining me for this episode of the Women in Wealth podcast. You can watch the founder's video I created for you to learn more about me and how I can guide you towards your financial independence at www.forgewealth.com. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Securities are offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Forge Wealth Management are separate entities from the LPL Financial. Our show guests and their companies are not affiliated with nor endorsed by LPL Financial, Private Advisor Group, or Forge Wealth Management.